Happy Friday, everybody. We are doing a full portfolio review of my $50-something thousand growth portfolio. We're growing that thing to $1 million, maybe over time, maybe not, maybe it goes to zero, who knows. Also talking about OKTA earnings, talking about Mongo database earnings. So if you like growth tech stocks, if you like cloud stocks, you're gonna like this video. Here we go. As always, I believe in transparency. $53,600. We are down in total since February 15th, 2022, $11,800. We have put in $65,000 total, so not worried about it. I think we'll make it up. Here's the portfolio. Again, I hope nobody just copies me. That's not what I'm doing here. I'm sharing this to show transparently the stocks that I own so you know if I'm talking about a stock, if I own it or not. Datadog, CrowdStrike, Snowflake, Rocket Lab, Trade Desk, GitLab, Tesla, and Cloudflare. If you want more coverage of those stocks, if you want in-depth write-ups and things like that, the place to get it is my email newsletter, austin.substack.com. Let's get to it. So provided this email update on OKTA Q1 earnings. And basically, the shares traded up 5% today. It's Friday. They close at right around $98 per share, but they're down 55% year to date. The next 12-month enterprise value to revenue has dropped from 28 in July 2021 to 7.6 today. That's a major drop, 76% drop in enterprise value to revenue next 12 months. Since their IPO in April of 2017, the shares have increased from $23.51 to $98.38. That's a compound annual growth rate of 31%, which would have turned $10,000 into $40,000. So even with this crazy drastic drop, long-term investors, if they found OKTA on the IPO day or shortly after, they could have gotten in much lower and still had a fantastic return to date. That's how long-term investing works. We don't just get excited and buy into the hype and buy trash companies. We want to find great companies and hold them long-term. That's my goal. This is the results. 30%, 31% compound annual growth rate for OKTA, about 13% for the SPY. The difference there is turning 10,000 to 40,000 in OKTA versus 10,000 to 18,000 in the SPY, or if you're invested in the S&P index. But maybe that's a lot less stressful and that meets somebody's goals. So nothing wrong with index fund investing. This is a chart showing the trailing 12-month enterprise value to revenue. It's currently at 10.8. That just looks at the enterprise value compared to revenue of the last 12 months, not the forward 12 months, which is what we just looked at. That's only 20% higher than its all-time low of 9, which happened back in 2017. So question is this a buying opportunity or a falling knife? Last thing we'll cover about growth. Revenue per share, which takes into account share dilution, that's when they issue more shares through acquisitions or stock-based compensation, has grown 30% per year since the IPO, and analysts are expecting revenue per share to grow roughly 32% from fiscal year 2023 to fiscal year 2025. So again, that could be a great buying opportunity. A recap of the results, right? So 15,800 total customers, $2.71 billion in remaining performance obligations, and a 123% dollar-based net retention rate, which tracks how much customers that are with them 1 year spend in the next. If it's over 100%, so 123%, that means customers on average spend 23% more year after year. That's like free marketing. They don't have to pay to acquire those customers. They're getting 23% revenue growth just from their existing customers. Quote from Todd McKinnon, "We delivered solid first quarter results highlighted by strength in new customer additions, dollar-based net retention rate, and the success we're having with large customers as they continue their journey to the cloud." Their outlook for the second quarter of fiscal year 2023, their guidance, management expects total revenue of $428 million to $430 million, representing a growth rate of 36% year over year. That beat analyst expectations. They also beat analyst expectations on non-GAAP net loss per share. They beat those expectations by about 2 cents per share because they came in guiding at a loss per share of between 32 and 31 cents versus what analysts expected, right around 30 cents. For the full year, they guided to revenue of, they increased their guidance to revenue of $1.805 billion to $1.815 billion, which represents a growth rate of 39 to 40% year over year, beating analyst expectations by 30 million or 1.7%. And then on the non-GAAP net loss per share, $1.14 to $1.11, assuming weighted average shares outstanding of 157 million, beating analyst expectations by 12 cents or 9.6%. So they guided to at least $4 billion in revenue and 20% free cash flow margin in fiscal year 2026. That is expecting growth of 35% each year through fiscal year 2026. The key drivers they see are faster penetration of their new products, continued growth at large enterprise customers, expanding partnerships, and international expansion. In the email, I covered more management commentary. The only thing I'll cover here in this quick video is they had a security violation in, I believe it was in Q4 of last year, so last quarter. The CEO, Todd McKinnon, said, while we've done a lot of analysis, it's difficult to attribute any quantifiable impact on our solid Q1 results. When looking at key indicators, our competitive win rates and renewal rates have remained strong. In Q1, our remaining performance obligations grew 43% and current RPO grew 57%. Total revenue grew 65% in Okta standalone, so that's our organic revenue without taking in their acquisition revenue, grew 39%. New customer additions remained strong at 800. They brought their total customer base up to 15,800, representing 48% growth. And they continue to do well with large customers. So a lot of people were really worried about that violation. They thought customers were going to leave. They weren't going to be able to sign new customers. And there's no signs of that being an issue. And so let's get to my takeaways, and then we'll move on to Mongo database. This was a strong quarter considering macro fears and Okta security incident in Q1. Management seems confident and excited about both international and federal opportunities. Management reiterated fiscal year 26 goal of $4 billion in revenue and 35% organic growth and 20% free cash flow growth. It's on my watch list because it has a low multiple. It's in an important market. Growth expectations are there, but I'm hesitant to start a position because of questions around profitability at scale, and I think the market is really focused on that right now. And there's other companies I can own that I might feel better about, which I obviously shared with you just a minute ago. In here, I've got different charts that show the price multiples, the fiscal year 2018, fiscal year 2022 results, what they've done, and then fiscal year 2023 to fiscal year 2027 analyst expectations. I'll link to my newsletter below. If you want access to the spreadsheet, you can go there and find it in this write-up. Let's talk about Mongo database. So Mongo database reported earnings on Thursday. They were up 13%. The stock was down today, but the quote from their CEO after their results, they believe that their Q1 performance is additional evidence that Mongo database is leading the market through a major secular transition, which is still in the very early innings. Q1 2023 financial highlights, they came in with revenue at $285 million, up 57% year over year, beating their prior guidance by $20 million and beating analyst expectations by $18 million. And then non-GAAP earnings per share was 20 cents. That beat their prior guidance by 30 cents, and it beat analyst expectations by 30 cents. Business highlights, Mongo Database Atlas, which is their big revenue driver. That's where they're putting their efforts for the future. Revenue was up 82% year over year, representing 60% of total Q1 revenue. Customer count was 35,200. A customer win, a leading global semiconductor company chose Mongo Database's data platform to power its new business unit that focuses on next generation technology geared towards AI, robotics, and autonomous vehicles. The group chose Mongo Database Atlas to provide real-time alerts on manufacturing floor, as well as implement search capabilities to their end customers, all while improving performance. And then a partnership announcement. They announced a multi-year strategic collaboration with AWS that includes integrated go-to-market activities for sales and marketing, as well as technology integrations and incentives to streamline the migration of on-premise workloads to Mongo Database through AWS. They provided fiscal year 2023 guidance. The midpoint guidance increased by $16 million over what used to be guidance of $1.16 billion that they provided in Q4, and then they beat their Q1 23 guide by $15 million. So that means management is conservatively confident, I just made that up, that they will continue beating prior expectations for fiscal year 2023. Non-GAAP net loss per share guidance is improved from a midpoint of negative 40 cents per share to a midpoint of negative 24 cents per share. Management commentary. Overall, our market opportunity is robust and unchanged from when we last spoke to you, having lived through a few macro downturns. Everybody's talking about macro downturns. I'm confident in our ability to win workloads, even in an environment where IT budgets could come under pressure. Our customers use us for mission-critical activities and initiatives as the economy becomes increasingly enabled by digitalization. we believe companies will continue to prioritize building custom software that provides a better customer experience, enables new capabilities, or drives greater operational efficiency in their business. They operate in a very large market. Despite their success, they still have a tiny share. They're fortunate to have significant growth opportunities in this market, including the ability to continue to acquire new customers, expand their footprint. So my take, it was a bullish report. They continue to execute extremely well. Their results should be viewed as bullish for all cloud and SaaS stocks. Management's commentary was conservative, but confident, and speaks to the importance of investors finding companies that innovate quickly and offer business-critical products and services as we enter a potential recession. As always, thanks for watching. Let me know in the comments if you own Mongo database or Okta, if you think I'm crazy for not owning them. If you've got any stocks you want me to review, request it in the comments. And then do me a favor, you can support me by liking this video, subscribing to the channel. And the last thing I ask is have a good weekend, take care of yourself, take care of others.